Today I want to talk about how the government and the Fed have just started bailing out hedge funds as a result of them taking on massive losses this year. But these are only temporary bailout measures, and it won't be long until these are exhausted and a massive inflow of liquidations is seen. So stay tuned and let's make some money. And now I want to dive straight in with the key information. So, Unusual was tweeted saying New York Governor Kathy Hochul has allowed state and New York pensions to increase its holdings in alternative assets like hedge funds. Basically, this is saying the New York Governor has allowed many pension funds to invest more money propping up these hedge funds. Now, this is bad for two reasons. A, it means these hedge funds are being given more money to prop up the market on risky derivatives. And number two, this puts actual taxpayer money at risk. It's not these hedge funds increasing their own leverage ratios, losing their own money. They're going to be losing money of the average American taxpayer. It means these hedge fund managers will be investing a larger portion of their overall portfolios into risky hedge funds, trading and investing in risky derivatives. How obviously this is only a temporary measure as the cap is only being increased. At some point these pension funds are going to run out of money and these hedge funds will be back at square one. When these hedge funds lose the additional money given to them by pension funds, they will again be approaching these margin calls and will be liquidated. As a perfect example of just how much money is at stake here, it says the top 25 hedge funds received pension fund allocations of about $164 billion. Bridgewater Associates received $47.3 billion from pension funds, which constitutes nearly 62% of the $76.1 billion fund it runs. Obviously now this limit is being increased. It means these pension funds can invest more money into hedge funds like Bridgewater Associates, potentially losing more money of the average taxpayer. We know that many hedge funds like Tiger Global are so far down over 50% this year, basically meaning they've lost over 50% of taxpayer pension fund money. And again, we know that other funds like Melvin Capital have lost so much taxpayer money, they've actually had to wind down the fund. Other hedge funds like Citadel, for example, are taking on heavy losses and have therefore limited investor withdrawals. But it seems these hedge funds don't care about the taxpayer and they don't care about pension funds. All they care about is receiving more money to avoid those margin calls. This article is titled How Britain's Pension Fund Hedge Became a £1 trillion Gamble. It says it started out simply enough. British pension schemes were looking for a way to match their assets to future pension payments. It says, and 15 years later, the strategy now adopted by nearly 2/3 of pension funds has ended up revolving around financial derivatives rather than just bonds, injecting a growing amount of risk into these pension funds. And obviously recently, those derivatives came close to imploding, forcing the Bank of England to pledge on September 28th to buy bonds to calm the panic. And John Ralph said pension schemes were doing disguised borrowing through hedge funds and it's absolutely toxic. He said there was much greater risk in the financial system than anyone, including me, would have thought. These pension funds have obviously been chasing returns by taking riskier and riskier bets, investing in these hedge funds who are unknowingly using their money on risky derivatives. And instead of curbing the amount of investment these pension funds can make into these hedge funds, instead the New York Governor is lifting that cap. That's going to allow for more pension money to flow into these hedge funds that they can continue using on risky derivatives, but also that they can continue losing until again they end up being margin called and liquidated. As I said, this is simply a temporary measure. The government isn't stepping in directly and providing taxpayer funding, and they aren't changing the rules on what these hedge funds are allowed to do. They're effectively just delaying the inevitable, and many of these hedge funds will end up being liquidated. And as a prime example of just how close these hedge funds are to being liquidated, Samuel Clemens tweeted saying heartbreak feels great on a place like Wall Street. He said it seems to be much harder for these hedge funds to short AMC without their tokens and their token futures. Guys, if you didn't already know, you can currently get 20 free shares worth up to $2,000 each with Moomoo. Moomoo is also currently giving away $60,000 for their giveaway sweepstake, and you can get all of this by signing up to Moomoo right now using the link in the description below. Moomoo is a very easy and very clear platform to use. They've got tons of technical indicators and they don't engage in payment for order flow, as I proved in one of my videos recently. We can see the cost to borrow average for AMC has now increased to a whopping 279%. The maximum is at 323%, and the cost to borrow minimum, the all-important one, is at 208%. That means that every single hedge fund out there right now is paying at least 208% interest per year to borrow AMC and APE shares. Yes, right now they are continuing to short AMC, but it means they're having to pay 2 times their total short position just in annual interest fees to keep that short open. If they're currently shorting AMC with $10 billion or $20 billion, it means they're paying at least $40 billion in annual fees just to continue shorting. Now we know these hedge funds can no longer use their FTX tokens and their FTX token futures, but on top of that, as Citadel has tweeted, he said it looks like the Chinese stocks are all out of their collateral. You may remember HEDGE, the stock that earlier this year rocketed up from around $10 on launch day all the way to over $2,000 per share. It did peak again back in September, back to over $200 or $300, but has since then trailed off all the way back down to $10. This at one point was a $300 billion company, or $300 billion of excess liquidity that was generated out of thin air. However, this $300 billion has now disappeared into only $2 billion. Again, we saw the same thing with MEGL and ATXG, stocks that previewed around $800 per share and around $250 per share that have now returned to only $1.25 and $1.04. Again, that's billions and billions of dollars that has now been wiped from these hedge funds' available liquidity, again bringing them closer and closer to that margin call. That obviously ties in with the removal of the FTX synthetics as well, and as Citadel said, he said it means it should be spicy for AMC and GameStop this month. He said, remember, you can't predict their next move or just how much crime they'll commit, you can only understand and read the numbers. He said it looked like November and December we could have had them, but they pulled another move and now it's looking like my original thoughts of January to March. Now we know that these hedge funds are losing margin left, right and centre. They've already lost the pension fund money, which is about to be topped up, but they've also lost their Chinese stocks and they've also lost their FTX synthetics. But on top of that, their blue chip stocks have also been destroyed as well. As Gavin tweeted, he said Amazon is now back at its pre-pandemic crash levels. We can see that Amazon is now just about to touch those March 2020 lows, and on top of that, Apple has also broken that 52-week resistance. And as a result of many of these blue chip stocks reaching their pandemic lows, Andrew Huizinga is tweeted saying a $700 million put spike just came in for the S&P 500. And again, shortly after that, there was another $500 million spent on S&P 500 puts. That basically means that one singular hedge fund out there, or multiple hedge funds out there, just spent over $1 billion on S&P 500 puts. They're clearly expecting the S&P 500 to fall heavily and very, very soon, potentially over the next week or two. It seems the market crash is about to resume, but this time without that Chinese collateral and without those FTX synthetics. He said scaring people into selling by aggressively dropping the price is the only play they've got, and it's simply not working. He said in theory, every short will be a future buyer. And whilst we know this isn't always the case over the short term thanks to those FTDs and these hedge funds kicking the can, when you refuse to sell them back the shares they've sold for peanuts, there may well be fireworks. He said, I don't know how long it will take for true price discovery to happen, but I know I'll kick myself if I don't load up on as many shares as I physically can at these ridiculous prices. He said, sure, they could dip it further, but my game plan is just to keep buying no matter what the price. This is one war they don't get to win. I think ultimately he is right. These short sellers won't be able to sell a box AMC and GameStop. They won't be able to drive them into bankruptcy because AMC and GameStop are both successful companies. Therefore, if they can't sell a box and bankrupt AMC, they cannot continue paying this 200% short interest fee forever, and therefore at some point they will have to cover. And obviously these hedge funds cannot cover billions and billions of synthetic shares without causing the squeeze. The only way they can cover all of these shares without causing the squeeze is if you sell shares directly to them at cheap prices. If they can buy these shares below the current market value with limit orders, it means they can cover while dropping the price further. But obviously I do believe that many apes will not be selling shares at these low prices and will be waiting for the squeeze. But guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell because that way you'll be alerted when I upload a new video. Cheers.